Okay, Michael, we are live. Today we did not have this little French
I'm
sentence.
really confused by the lack of French on this podcast.
Yeah.
I don't even know how to start.
Plus, today our guest is not French.
It's not French.
Like-
So can I take the piss out of you and say, should we do this one in English? Or?
yeah. You can.
Okay, I'm happy to do this in English. Welcome back to E-commerce Undercover.
How are you, Michael?
I am super. Let's welcome TJ Hyland, the Director of Global Partnerships for Elevate Brands. TJ, how are you doing?
I'm doing really, really well. Michael Martin, thank you for having me.
It's my pleasure. Look, where are you based again?
I am in Austin, Texas. So it's
I love the Christmas tree in the background, by the way.
That's awesome.
Well, the Christmas tree goes very well with the Longhorn up here. So
Wait, but are you originally from Texas?
not. I'm born and raised in New York City and Brooklyn. I moved to Austin in originally in 2015 and jumped 2 feet in and embraced it fully.
Did people from Texas know you were from Brooklyn? Could they tell?
Initially, yes, because I was,
Very Brooklyn-y.
yeah. I mean, more so maybe they could tell by how not as nice I was as they were. Every morning you get in the elevator, good morning, how are you? And like the first couple of months, I would just look at them like, why are you talking to me? Like,
Please
it doesn't
leave me
make
alone.
sense.
Right.
Now I
Nobody's
say
talking to
good morning. Now I say y'all. Like it rubs off on you. It especially y'all. It is a nice contraction that makes things a lot easier.
Yeah, it does. It's a great pronoun, right? It's a catch-all for everything, I guess.
Yeah.
Yeah.
Y'all do all
stuff.
that. Yeah.
So do you want to give us a little bit more of your background just for some context before we jump into the main part about Elevate? Yeah.
Cool. So yeah, a little bit about myself. I've been in the Amazon online selling world since 2014.
Oh, wow.
Previously in regards to more so in the cross-border payment space. So I had previously worked at a company called World First and then a company called Payoneer. So both really helped businesses that were based in one country, listing and selling on a marketplace or Amazon or Walmart or any of the ones in France like Rakuten or Price Minister, bring their funds home. And then they would also help with supplier payments, so making payments to China or Southeast Asia or Latin America, just any sort of cross-border payments, because typically banks did not do that very well. So most recently I was at Payoneer as the head of partnerships responsible for North America. And then about 5 months ago, I moved over to Elevate Brands. And Elevate Brands, I'm sure we'll dive in there. But what we do is we are a, quote, aggregator. So we're looking to buy businesses that sell online and more specifically or majority those that sell on marketplaces or on Amazon.
And is Elevate based in Texas, or is that just something you decided to? I mean, it doesn't have to be based anywhere. I'm just curious.
Well, we are a global company. I think on paper, our address might be in New York, but we have two real hubs, one in Midtown Manhattan in New York, and then the other in Austin here, just down the block from where I am. I'm at my apartment now, but usually I'm in an office.
So here's what I want to know, just to jump in and start right away. Yeah.
Let's go.
Elevate was founded in 2017. So it's not like one of these like newfangled copycat companies that just sees what everybody else is doing and is doing it as well. What did, James and Jeremy and Ryan know back in 2017, or what did they see that nobody else saw?
Yeah, so the story starts where James and Ryan were in retail arbitrage. So they were actually resellers on Amazon before we got into this aggregator space. So for about a year and a half, they were reselling products on Amazon. They acquired this large army of buyers that would go out to the shops and buy actually name brand Adidas and Nike shoes, and then use the Amazon app, figure out which ones they can make a profit on, and then list them on Amazon. They grew that business to about a $25 million run rate business by 2018, 2019. And then that was similar time at the emergence of Thrasio, who's probably the biggest, quote, aggregator in the space. Right. And they said, oh, cool, like we will, they didn't necessarily know right away what to do with this. And this reseller business was also kind of fading out from a general seller perspective because you're not really building anything. Perhaps you're building your reviews on Amazon, but there's nothing for you to exit with. There's nothing for you to capitalize on. They went to go sell the business, and one of the brokers that they were using said, you don't really have much here, right?
But also
You don't have a
arbitrage.
product. Yeah.
Arbitrage by definition, if there's an arb, right? I come from a stock and bond trading background, right? So if there's an arbitrage in something, it's going to close as more people get involved in it. And you're right. Once the people doing the arb leave or are done, there's nothing there. So good point.
Right. And I mean, it's the same time where there's more and more sellers selling the same thing. So you get competitive, but then also Amazon started working with the brands themselves and giving them much more control over who sold what. And a lot of times you needed the permission or the license or whatever it is to sell this on this marketplace in this region. So the headaches were piling up. So they act in the January of midsummer 2019, they actually launched their first product. And we still sell it, and it's super successful. It's called Sun Ninja, and it's a beach tent. That's pretty nice. And like I said, it's still selling and all around the world now. And they got into that and said, we know what we're doing in terms of running an Amazon business. They had done it for 2+ years before that. Right. And then they said, well, what if we wanted to buy these businesses? So that's where actually Jeremy Bell enters the picture. Friend of a friend. And Rob Bell is Jeremy's brother. And Rob and Ryan had worked together in Jakarta for 9 years trading commodities.
Oh, wow.
So, yeah, they worked. I forget where they worked. Sorry. They were in Jakarta for a while trading commodities. They have worked together. And Jeremy has a pretty extensive background in M&A. So about a little over 2 years ago, we acquired our first business. And kind of just the ball kind of rolled from there. To date, we have about 30 businesses in our portfolio and adding a significant amount each month.
How has the acquisition of the businesses changed since the first one? I'm presuming when the first one was acquired, it was more, I don't want to say seat of the pants, but more like, hey, that team is doing some great stuff. Let's do some due diligence on them and then let's figure it out. And I presume today it's much more sort of data-driven and technology-driven. I'm curious how that process has changed over time.
Yeah, we often talk about our first acquisition. It's
like your first girlfriend. It's like, I didn't really know.
Yeah. And what's really interesting is it was something in the feminine product world. And it was a couple, 80-year-old couple based in Arizona, and they were looking to sell their product, right? So they had sold on eBay for a long time. They had a ton of stock, and his wife was like, figure this out. So this guy just started listing on Amazon. A couple of years later, we came across this. I think, at the time the business was doing, had an EBITDA of about $80,000. So not very big in terms of, what we're paying or what we're seeing today. But so we acquired that business. And what's quite interesting is Jeremy, along with Ryan and Rob, were the ones that actually ran that business from an account management perspective. So, from the top down in our business, everybody has actually run and sold and managed a business that operated on Amazon. So that's kind of why we differentiate ourselves from a lot of the other aggregators, is because they have sold, and we do consider ourselves more operators than aggregators.
Right.
But I still put ourselves in the aggregator bucket because it's a lot wider range. It's a lot easier. It's fun.
Yeah, for people to understand. So what's changed now? I presume when you do that now, you're not just like running around the internet looking for small businesses. It's changed a lot, yeah?
Yeah, it's changed definitely, as we've grown in terms of raising money and the size of the team has grown. The size of the businesses that we're acquiring and that we're able to acquire has obviously grown. So that business was doing a run rate of less than $100,000. Right now, we're looking at businesses doing at least $1 million a year in EBITDA.
Can you tell me? Yeah, can you tell me what happens? Let's say I'm really curious about this. I'm running a brand. I'm doing $1 million in EBITDA, right? And then Elevate comes along and says, "Hey, Michael, we want to." Buy or acquire your, I don't know, let's just call it your ring light business.
Yeah.
Right? Because it's going okay, but we feel like we can run it better. Once we kind of get into due diligence and due diligence is done, let's say, what happens? Do you know what I mean? Like, what happens to me? What's that whole process like?
What I would say is it depends, right? Every situation is unique, and every owner wants something different. A lot of the aggregators in the space, and us included on a majority of our deals, will say, 100%, we'll buy your whole business. See you later. You go retire in Bali or in Bangkok and have a good time, right? I mean, I wouldn't mind that either, but but not everyone wants that, right? And not everyone's ready for that. So, you know, we're much more open to that. You know, a lot of the times we will be open to the founder or the entrepreneur, the guy or the woman running it, staying on, right? Either as 100% acquisition. So there's a business that we just closed where we did acquire 100% of the acquisition, but in the deal structure, there's things called earnouts where the business has the opportunity, or the original owner has the opportunity to earn more based on the performance of the business going forward. Now that owner, the original owner, wanted more control over the situation, right? So he and his team are going to stay on for the 2 years in which that brand has those earnouts in place, right? That's one example. He took his money, he's fine, but he's still going to now work as an Elevate employee. Right. The other example is, you know, a lot of the times there's that sort of period after sale where they are required to provide a number of hours to us, right, as the transition happens. That's kind of like the most simplest term. But then from where we differ is, you know, we do a ton of partnerships and joint ventures where, yes, the original owner gets their pay upfront, gets to take the chips off the table. But in many instances, they are coming on with their team to operate, and they have those earnouts in place, but they also have a second exit lined up as well, right? At an agreed multiple that in 3 years, 4 years, whatever it is, you know, they will have the opportunity to exit. That really happens majority in the partnership situations because we're acquiring a majority. If we have 70% and you as the original owner only own 30%, who's going to want to buy 30% of a business, right? If
nobody.
We would buy the remaining 30%, but who's going to want to buy your 30? So, you know, pretty flexible. And like I said, it really depends on ultimately what the seller wants or the original business wants to do.
Yeah, I mean, my idea here was that some of these people that found these businesses that are doing really well, that are doing $1 million, $5 or $10 million of run every year would think, hey, I'm doing okay. I want to run this myself kind of thing. Do you run into situations where you see a business that you like, you run it through your data structure, and you think we have to acquire this because this is going to be great? And then the seller just says, or the owner of the business just says, no, I think I got this on my own. And then you have to convince them, like, but here are the things that we do that are going to increase your sales by 30, 40, 50, whatever the number is %. And then they change their mind and say, yeah, actually, that makes sense to me because I didn't know that thing.
Yeah, the almost always the barrier, like when we approach a brand and they don't come to us, but we approach a brand and say, you know, we really like your brand, excuse me, and we want to buy your brand. And, you know, the barrier usually is, I'm not looking to sell. I'm not ready to sell, or I'm not ready to sell, right? A lot of them don't know what they're going to do. So they're not ready to sell. So then that becomes a dialogue. And it comes back to what I'm saying is, depends on what the seller wants. If they don't want to sell and they think that they can grow this business to 5x where it is now, and then they want to sell, great. You know, you can do that. But there's a couple of things that I do know. One, the biggest issue with e-commerce business is capital, right? And a lot of these sellers can get to the 1 million, 2 million EBITDA range, but then to 5x that, you know, that's either going to take 5 years or that's going to take a ton of capital. You know, I often say that, you know, sellers know how to sell. Right, whatever you give them, you know, they'll find a way between the keywords and the listing and the optimization and making sure the margins are right. But you know, it's you can only grow as fast as your capital allows you. You know, probably the most popular thing that we do see though is when a business does exit to us, they start again. Like that entrepreneurial spirit is like deep inside. They start another brand, and we've actually had a guy who has sold us multiple brands now.
That's funny.
So there are people actually out there building brands to sell to aggregators.
That is absolutely a new term called build to sell.
Build to sell.
That's interesting. And
because they're not, sorry, just one point. They're not trying to get it up to $5 million. They're trying to get it to $1.5 million EBITDA, get 4x, 5x, and boom, here's your payday. And then the next business, they have more money to start, right? They can take a little bit more risk up front rather than maybe when they started in 2016, 17, 18.
Interesting.
That's very interesting. And I'm wondering, like, once you acquire the brand yourself, like, what is your goal? Do you like keep the cash flow every year, or is your goal is to sell as well? Like, what is your process?
Yeah, we're not looking to flip businesses. We're looking to build our portfolio, a diverse portfolio, and really what we're looking to do is to grow these brands. Right? It's not enough for us to maintain $2 million EBITDA or whatever it may be. You have to think. Where do we get our money from? A lot of it is from private equity, and what do they want to see? They want to see growing returns,
Growth.
right? So we have growth targets that we have to hit as well, on a brand perspective, but then like the overall portfolio.
So is this a private equity investment as opposed to a venture capital investment?
It's a mix. Yeah. Yeah. And I think you'll see across the industry, some of it's VC, some of it's private equity. Majority of these deals are debt deals. I think they just announced like the total in the calendar year of 2021, over $12 billion has been raised by Amazon aggregators, which is a staggering amount, given that this business model didn't even exist 3 years ago.
So this is another question for me. I believe in, and I don't love this word, but I think that omni-channel is going to run retail forever, right? All of it's not going to be online because people like to go shopping. They like to go shopping with their friends. And we see even some of the most successful e-commerce brands out here, not opening, but have opened offline stores and are using those stores in a really creative way. They use them as, excuse me, they use them as warehouses, they use them as pickup points, as try-on places. And they found that having offline stores has raised their ability to sell effectively. Do you see yourselves doing that as well? In other words, am I going to wake up one day in 5 years and just have a mall in Illinois somewhere that just has Elevate brands in it? Do you know what I mean? Where it's just called the Elevate Mall, and then offline I go in and I can buy one of these and two of these from some of the brands that you guys own?
Yeah, absolutely. A sort of goal for us is that within 10 years that, an end Elevate product is in the hands of everyone in the US, but like in the world is not unimaginable either. We have hundreds of thousands of SKUs right now, so there's a lot of opportunity there. But when talking about omni-channel, it's directly tied to the growth that needs to happen, right? Sure. You can only really grow so much online. And, what we're doing a lot is taking these brands that are historically just selling in the US and expanding them internationally. That's probably number one.
Right. So I want to get to, go ahead.
Just to wrap the point, number two is looking at other marketplaces in the US, looking at D2C solutions, Shopify stores or anything like that. And then the fourth one, when applicable, is retail, right? Like there's some products that would fit very well in, Home Depot or like some very specific niches too.
So you can help a brand that normally only sell on Amazon's to go omni-channel and like to sell also worldwide, right? That's kind of like the main part of a strategy that you use for growing them.
Yes, 100%. Okay. Every brand's different, right? And not everyone's going to make sense to have their own D2C store or to be in retail. But when applicable, we want to be able to pull every growth lever that we can.
So I really want to understand international expansion, and this is your main thing, I'm guessing, right? I mean,
I am very experienced in international expansion too. Yes,
I like it. And just so you know, like I've been living in Asia for 30 years, so I've been following the sort of distribution of new brands coming in, but also brands coming from Asia into the United States and into Europe as well. So for me, this is just like a fascinating thing. How do you what's the strategy for taking a brand, and how do you know when you look at a brand if it's going to be okay or applicable to be expanded into sort of growing overseas markets? You know what I mean? Like, what are you looking for?
Yeah. So, the first thing is product market fit. Like as we would evaluate that in the M&A side of things, in the mergers and acquisitions, when evaluating a deal, how it fits within the US market, we would look at that in how it fits in Europe generally first, or how it fits in Canada. A lot of the times the businesses will already have either some sort of presence or tried it or this and that, maybe didn't fully invest in it. But that, from our perspective, we're looking at product first. And then you look at consumer habits, right? So the consumer habits of someone in Germany and what they buy versus someone in the US is very different, especially then compared to Southeast Asia or to Japan or to China, right? All the buying habits are different. So you also have to see like what the competition is like in those regions, right? Like if you know, you're likely not going to want to take your electronics product and sell it in Japan, right? Because they really value high-end electronics, right? And they're willing to pay for that. But in other regions, like, you know, if you have or in Japan, for example, again, if you have something that's made in the US, you can sell that in Japan with a premium on it. Japanese don't want you to take something made in China and then just sell it to them. No. Similarly, like if we look at Germany, right, and toys, like children's toys are booming right now, but the Germans are not very high on the plastic side of things. They don't want plastic toys, but a thing that is booming is wooden toys for children, right? So all this research is put out by sort of not even just the e-commerce, but the retail and the consumer habits around the world. So it's kind of taking what they've done, looking at our portfolio and expanding that. From a growth plan perspective, you know, we typically start with the Canada and the UK and then mainland Europe, right? For a couple of reasons. Amazon is there. You know, Amazon here, Amazon there, they generally speak the same language. You know, the way our operations are set up, we have a brand manager who's assigned to each brand that we operate. And for them to understand, you know, Amazon UK and Amazon US and Amazon Canada, it's not too different from one another. Perhaps, you know, there's slight changes you need to make to the listing and, you know, and from a localization standpoint, rather than a full translation to Japanese or to, you know, German or whatever it may be. Right. And then also logistically, right, the infrastructure with Amazon and what FBA provides in Europe and in Canada and also Mexico, even from the US. It really just depends on where the products are landed. But we have a full team that focuses on international expansion.
So just that's interesting because, yeah, definitely, like if you have Amazon FBA, we can help you with the logistics side of that. It's going to definitely help a lot. And what do you do about like the legal side of that, like regulation, VAT, and all of that kind of stuff? Because when you go to Europe, for example, like that's a lot of work. Yeah. So do you have partners who are working for you on this part, or do you have like your team inside the company? Like, how does that work?
So we have some finance people who sit inside our company who handle, in conjunction with the international expansion team, a lot of the VAT setup. But, you know, I come from the service side, right? So now I'm all on the brand side, but I come from the service side, the partner side. I love leveraging and letting the experts in the space do what they're great at, right? I never wanted to be great at everything in terms of a seller perspective, because you can't be, what is the expression? Master something, master of none, right?
A jack of all trades and a master of none.
Thank you. So like you can't do that, right? You know, if you are an Amazon professional and you're good at listings and you're good at this, and then you let the people that are good at logistics and good at localization and good at VAT and good at, you know, European tax handle that stuff. You know, that's why they exist as companies, right? They saw a gap in the market to do it better than sellers themselves could.
Was international expansion always part of the business plan, or is this something new? I mean, you said you were hired 5 or 6 months ago, right? Is this something new that they're trying, or are you just new to this part of their business?
It has always been part of the growth plan, but it hasn't always been executed, or it was on pause to figure out what's going on in the US. But you know, probably mid this year, it was given a larger initiative, and next year it is 100%, right? Because when we look at it on paper, based on historical trends, you can do about 40 to 50% of what you do in the US across mainland Europe, including the UK, right? Okay. So that's an easy way to grow the business. You can probably do 10 to 15% of what you do in the US in Canada, right? But, you know, it all kind of grows with us. So as we have more money to operate these businesses, to spend more on inventory, you can, because you don't want to take from your pie that you have in the US to sell in the UK and to sell in the EU and to sell into Canada. You want to continue to run this operation in the US, and then have additional inventory for here, additional inventory for there and there, right? So that's how you're going to grow. If you're just taking from the pie that you have, that's not really going to help.
Not really. Do you look at Southeast Asia or Asia in general? The reason why I ask is this, is that the growing middle class here is also an English-speaking middle class, right? So part of the way that the educated elite here run businesses is they send their kids overseas, they study in the UK, they study in Germany, they study in the United States, they come home, they build businesses themselves, their families get wealthier over time. There's 670 million people in Southeast Asia and 1 billion people in India. China is its own market, right? I wouldn't even consider expanding there. And most of this stuff you're probably buying is coming from China anyway. So to then sell it from the US into China is senseless. But do you see expansion into the markets here? And is it a language problem? Is it just like, I don't know what's going on there kind of problem? Do you know what I mean? I'm really curious why more companies don't expand here when the markets are so big and they're growing so fast.
Yeah, I've asked this question for a number of years.
Interesting.
And I think it's from a U.S. business perspective, I think there's just a ton of unknowns. A big first step was Amazon Singapore.
Right.
I think a lot of businesses are trialing that, testing that, understanding what they have there. Right. So it goes back to, why do we expand to the EU first? Is because Amazon's there. Like I said, they speak the same language in terms of messaging, in terms of platform, in terms of that side of things. So Amazon Singapore provides that opportunity. Lazada, I think, is another opportunity,
or
right?
Shopee, yeah, same thing.
Yeah, right. So it really depends on consumer behavior for us too, right? So all of this research has to go into that and say, if we invest in Amazon Singapore, then it's like, okay, cool. Well, what percentage of the population buys from Amazon versus buys from Shopee or from Lazada, right?
Right. And the other question for me, I mean, I have a lot, but you said you're also looking at DTC opportunities and stuff like that, stuff that's off of Amazon. I mean, at some point, the Amazon opportunity is just going to get squeezed, and we can talk about that in a little bit too. But there are massive opportunities in direct-to-consumer and factory direct-to-consumer as well. How do you organize and aggregate that as a thing so that you don't get necessarily like run over by other people that are going to try to do that first?
It's a very good question. If you take a step back, I think the first thing that we need to do, or that we've done and we're doing constantly, is looking at organizational structure of our business, right?
Business, okay. Yeah.
From an Elevate Brands perspective first, before even applying it to the brands that sit under our portfolio, right? So, like I said, international expansion was a very big initiative. H2 last year into next year. There's a full team that has done the research, has started acting on it, launched the listings and the shipping, etc. So similarly, when we get to D2C, right? So we're building out the team now to launch that, right? To figure out which brands are best. And to be honest with you, a lot of the brands that we do acquire come with a D2C presence. It's a bit of a debate whether that's valuable or not to the value of your business, because unless you're doing 5 to 10% of your sales on D2C, what is it actually contributing? So a lot of them come in with this, and we'll either pause it until they're ready to ramp re-big, or kind of run it right away, because some of them are 60% Amazon and 40% D2C. The D2C side is incredibly attractive for us because you own the customer, right? In many ways in which you don't on Amazon. And you can market to them incredibly differently than you can on Amazon in terms of repeat buyers and subscriptions and retargeting.
And also you have all the SEO side of things. If you buy brands that have like a nice ranking on Google, you can have like tons of free traffic over time, and it's gonna flow into the stores, and like you don't even have to pay for it, right? There is no advertising cost associated to that. So like this SEO ranking can be seen kind of like real estate at some point on some keywords and some industries.
Absolutely. It should bring your overall cost down, because what you are in theory doing is building this global brand that people are going to search for specifically. And you own the customer because you own the entire experience A to Z, right? You're not just, sending a product and they get it in an Amazon box, or they get it in a Walmart box, right? You own the whole experience. You can offer different things. You can issue it at a different price point if it's a repeat buyer that, you know, reward the loyalty, where on Amazon you can't necessarily do that.
One of the things that Intel and Windows did back in the 80s and 90s was, excuse me, was that they said, you know, Intel did this thing with that little sticker on it that said Intel inside. You know, and Intel licensed their architecture so that AMD could make the same exact chips, right? The 86 series chips, right? Do you see a time where the brands that Elevate own would benefit from having like powered by Elevate, so that people know that they're dealing with the same infrastructure, if that makes sense?
Yeah, that's a really good point. Today, not yet, because, you know, I think we're still making way in the seller world to get our name out there amongst sellers. Right. So then, you know, when you try and elevate the buyer world, that's incredibly different. But when we continue to grow brands and get them to like the next level, then, you know, if you want to know who owns XYZ, you can see it's Elevate. And then once you have that rockstar brand, then it might make sense to say they all fall under this umbrella, like a traditional CPG company.
Well, like Procter and Gamble, or
exactly
any of those other brands, right?
Right. Like if you know it's one of their umbrella portfolio, you know, J&J, which might be J&J soon. But
really?
Yeah, they announced they're separate. They're like breaking up into different divisions. Yeah.
I need a tissue.
But the same thing, like in the food space, like Kellogg owns all these brands under Kellogg, right?
Right.
And it's like, you know,
you know that. And when they introduce a new brand, you're just like, you trust it because it has Kellogg written on it, if you do trust them, right?
Correct. Yeah. So
interesting.
Yeah, I hadn't really thought about that, but, you know, perhaps that is an interesting point. Maybe not today, but down the line.
I've got tons of these ideas. I'll give them to you for free. So there's no consulting charge here at all.
That's fine.
Actually, we always have tons of ideas on this show.
Which is why we love talking to people like you, because otherwise we wouldn't have the idea, right? If we're not having the conversation.
That's right.
And also the other thing is, you know, if you're competing against people whose companies have weird names, I really mean this, right? Like, you don't want to say like powered by some XGV kind of thing.
Right.
But Elevate's a decent name. Do you know what I mean? Like, it means something. So it would just be cool if you just said powered by Elevate or brand operated by Elevate. I don't know. I think it would be really powerful. And also, I think the earlier you start, whether you have a rock star brand or not, I mean, you're making rock star brands. That's up to you guys to decide. When you go in to buy brands, are you starting to feel like, and I'll tell you why I think about this. When I worked at Goldman Sachs in the portfolio trading business, right, periodically, probably 4 times a year, we'd get on a plane, I mean more, but to the United States and to Europe, and go see clients. And it was very seasonal, right? So we'd go see the biggest hedge fund managers in the world, and we'd go see the biggest portfolio managers in the world. But almost every time we traveled, like, we'd be sitting downstairs in the office of pick a company, BlackRock, BGI, whatever, State Street. And next to us would be the guy from UBS and the guy from Morgan Stanley. And it was annoying because we were like, you guys are losers. We're definitely going to win this business, kind of thing. But are you starting to see in the lobby of the businesses you're trying to buy, just metaphorically, other companies also showing up with the proverbial briefcase going, uh-oh, these guys are also bidding on the same businesses? Is that starting to happen already?
Yes and no. I think we definitely saw that more, maybe hit its peak around summertime this year.
Okay.
That, you know, everybody had just
and their brother
had just really announced a new round of funding and was spending like crazy. And, you know, multiples were at the highest that we've ever seen on average. Right. And from our perspective, it's like, that's beneficial for sellers, but that's also beneficial for us down the long term, right? From the valuation perspective. But, you know, we are seeing more and more competition. It has slowed down a little bit, which is nice for us. But, you know, what I would say is there's different buckets or different levels of aggregators targeting different sized businesses. Yeah. So you're not necessarily competing with the same people every time on every business. What I would say is everyone is active too. It's just a matter of, does this brand fit in what their vision is, whether it's their larger portfolio, or is this like a category defining brand? Are they going to build around this brand? But yeah.
Yeah, I mean, I just worry. We talked about it earlier. I just worry about the arbitrage. You know, one of the other things I think about is as you accumulate all of these brands, to take some of the, what's the right word, the power away from Amazon, do you ever consider starting your own marketplace? Do you know what I mean? Where just elevate brand sit and then drive traffic there. So slowly but surely wean yourselves. You can still use some of the Amazon services, but slowly wean yourselves off and just drive people to elevate where all the brands sit.
Potentially, right? That's like taking it from a D2C model on steroids, right? And controlling all the customers. I think from our perspective, we would want the portfolio to probably be larger. The one thing that is often like forgotten about is how much Amazon controls the buyer, right? And just it's really hard to replicate the traffic that they drive on an organic basis. Obviously, you then pay to them for ads and this, that, and the other. Right. But until you are able to create that brand that people are searching for organically, right, for either repeat buyers or because their friend told them or this, that, and the other, you're going to want to rely on the marketplace model that they have rather than maybe creating our own. But down the line, again, we'll put the logo on everything, set up the store, and I'll give you 1% royalties for 1 year.
You're done.
Sounds good.
I don't have that power. I know this is recorded. I don't have that power.
It doesn't matter. I'll never hold you to it anyway. It's just funny to laugh. It's funny to talk about.
But yeah, for sure, like at one point, if you keep buying some brands and if your brand like gets bigger and bigger and bigger, you're gonna have more and more traffic, right? And as you say, like the biggest disadvantage when you work with Amazon is that you don't control the customer, so you can't, so it's hard to repeat sales to them and stuff like that. So maybe at some point it can make sense either to push DTC a bit more or to aggregate all of your brands on one single marketplace, and then be able to control the customers. And maybe you see also some like, I would say joint venture, but that's not the word, but like some customer of one brand who could be customer of another brand. And like right now it's impossible for you to resell to and like to cross sell to them because like you're using Amazon. But if you own the customer, then maybe there's like some cross sales opportunity to be made this way as well, and to increase like sales almost overnight because you can just buy new brands based on what you already have. I mean, the customer that you already have, and just start selling to them.
Well, that's definitely part of the strategy, right? So I would say of the brands we have right now, I'll say 30 brands, 25 of them sit in 25 different categories. Okay. There are a couple that sit in like hierarching categories where you can share lists, right? You can cross sell to them if they had that D2C list. And that's really what we're doing now, is saying, okay, cool, we have these products or these businesses in these different categories, and how do we add on complement or acquire businesses that are complementary to them? So you're not starting at zero every time. You're saying, we're in pets and we know this worked with pets, and the buyer of pet food or the buyer of pet toys or the buyer of pet product, and we can apply the same models to that. Testing and trying out new things and learning from each brand, even if it's in home goods and then you go into, baby products and then you go into pet goods. And it's like, even though they're very different products, you can still very much learn from each other and different tips and tricks.
Is there a data aggregation angle here as well? In other words, as you keep acquiring brands, do you see patterns in data that you gather? And over time, as you gather more and more data, can you anonymize that data and then use that data to just like continue this sort of virtuous circle of, we see this happening here, we know it's going to happen in other types of brands and other types of products. And the more data you get, the more powerful and the better you can get at your acquisition strategy and also your sales strategy.
1000%, right? Data is key to all of this, in terms of the acquisition, in terms of making sales, in terms of raising capital to buy all of it, right? We use the data that we have, and it's actually we have an engine that's kind of plugged into from the M&A side to sort of not 100% automate, but like to take the data that we get from a brand that we're looking to acquire, whether it's initially their financials that they provide, but also the data that Amazon will share, either without them or with them sharing it, and plug that in to say, this is a good deal, this is a bad deal, this is a deal that we should do, this is a deal that we may want to look at more. Why? And then also, why are you looking at it, or why would you want to look at it more? This margins is this, that, and the other, right? So the more data you put into it, the better it learns.
Is there, and this is kind of a little bit of a different topic, or looking at things in reverse, right? You're taking brands that are in the US and trying to expand them overseas, into Canada, not over the sea, but over the border, right? Into Europe, into the UK. Do you see a situation where you'll see something getting built on Shopee, or something getting built on Lazada, or something getting built on Amazon in Germany, and then bring that into the United States in reverse?
I'm not sure if that has happened yet. But what I was speaking with the man, James, who's in charge of our international expansion program just last week. And he was saying Europe in general is behind the curve, right? Trends will go in the US first, then they'll go to China, and then they'll go to Europe. So from a production standpoint. So when he can say that, this product or this niche is booming for us in the US, then he can be prepared to launch that, or to acquire a business that might sell that in Europe. A specific example of that, and again, back to pets, is pet supplements, right? So we operate in pet supplements, yes, which I didn't know was a thing. I don't have a dog.
I love it though.
But it is, right? And it's booming pretty big in the US right now. And we have a brand that sells that. He said that hasn't even hit Europe yet. He hasn't even heard of it in Europe. But that product sells very well, or that business sells very well in the US. So from there, you hope to be ahead of the curve rather than non-existing curve, but you hope to be ahead of the curve. You might have to do a little bit more on the education side, but learning from what is happening in other marketplaces, learning from what is being produced in China, or now we're seeing more production being moved out of China to Southeast Asia and to Latin America, to hopefully prevent kind of the mess that there was last year. That's being polite too.
Yeah. That's the Texan part of you now talking.
But actually, that's a very interesting point of view. But as you said, that I'm wondering, like, all the aggregators that are outside of the US, are they doing the same thing? Are they targeting US-based businesses and trying to expand them to Europe, or do they have another strategy?
So I actually was speaking to someone earlier today, and he works very closely with a number of the European aggregators. From our perspective, it's a bit easier to take a brand that's selling in the US and to launch it in Europe, rather than the opposite, rather than to take a business that's only been selling in Europe and to launch it in the US. The main factor is competitors, right? There's way more competitors and competition and price gauging in the US than there is in the EU. I've seen that a lot of the European aggregators buy businesses that are already selling in the US. I haven't really heard of them expanding to the US, but I'm not fully in that. I know they have obviously bought ones. There's a lot of German businesses that only sell in Germany, and that's it. Right. And there's a lot of UK businesses that post Brexit have said, I don't want to deal with it. I'm only going to sell in the UK. Right. Even though it's the matter of getting an EORI number or a VAT number in mainland Europe. But, it really depends on in that case, it depends on the product and where the competition falls. If it's a super niche product, you can probably launch it. But if it's kind of middle ground somewhere, you'll probably have a harder time cracking the market in the US than you would starting from scratch in the EU.
Interesting.
I feel like everything moves faster today than it did 5 years ago, and 10 times faster than it did 10 years ago.
I would say than 2 years ago, it moves five times faster, right?
Fair enough.
Especially for you. 2 years ago and now it's really different.
As you said, there were, what did you say, $12 billion was spent acquiring businesses in an aggregation business that didn't even exist like 5 years ago. Did I get that number right or no? Refresh my memory.
It's $12 billion was raised by aggregators, not spent. But
fair enough. Okay.
That's insane.
Maybe you should just save it. But do you see if there's an aggregator here, an aggregator there, an aggregator there, and you're all sort of competing to buy similar businesses, does it make sense at some level, in the same way that banks and investment banks and every other business consolidates at a high level, that there will be consolidation into just like 3 or 4 big brand consolidators to remove, I mean, for a bunch of different reasons, but if no other reason than to remove the competition for brand buying, but also to go from 30 brands to 100 brands kind of overnight.
100%. And I think I do know that we've started to see that a little bit already. Some of this, excuse me, smaller aggregators that have maybe like a total portfolio of 7 million EBITDA.
You must chuckle at them, no? I mean,
well, the thing is, to your point, like yes and no. It's like 10 businesses, 7 million EBITDA. From our perspective, that doesn't really weigh itself in terms of value, right? Because now you're having to operate 10 different businesses.
Right.
We might want 2 of those or 3 of those, and we would pay nicely for it, but they're looking to sell their entire portfolio, and those are the key gems, and they're not going to be able to sell the other 7 or so that they have. But we've already seen that come across our desk. Not really sure the true root in the reason behind it, but perhaps their investors say, this is way too competitive, or you don't know what you're doing. We want our money back, right?
Right.
You know, we've been really grateful. We have very good investors. We just did a Series 1B where we raised, I think, about 55 or 60 million in majority equity. This calendar year, we've raised $375 million, and more to come in the next quarter or so.
Right. And normally what happens in these markets is that it bifurcates, right? So it's teams like yours that raise $300, $400 million a year, teams like Thracia that raise $1 billion. There's going to be, it just is what it is though, right? In other words, that's where the competition is really going to be. And then the smaller players who we look at from here and just think, you just raised 25 million bucks. Like, how are you going to possibly compete with people that have so much more money than you?
Right.
And I do wonder if there is this business where, like, I buy something, I increase its sales from 50,000 or 80,000, like you said, for this original business that you talked about, up to $1 million, and then I sell that on to you, kind of thing. Do you see that happening at all?
Yeah, 100%. We've seen that. You know, while we are operators and we're not looking to flip businesses, there are aggregators who are looking to flip. They'll take a business, they'll grow it 5x, they'll get it to north of that million EBITDA range, and say, let's exit, because they know that they can get their payday. They don't have to run it forever. They can go either replicate that somewhere else, take their money and run, whatever it may be.
Fascinating.
That's super interesting. And one question I was wondering as well was, if there is $12 billion raised this year, which is insane, is the market that big? Like, is there like that many brands to buy?
It's a very valid question. What we are starting to see, I think, is brands that are not majority Amazon being targeted.
Yeah.
Right.
So, okay, yeah. Go.
Yeah, just to finish that point, it's like everybody has kind of taken on the businesses that were majority FBA as well, fulfilled by Amazon, because from an operational standpoint, that's the easiest. Now it's kind of looking at the next level and, you know, saying, I have this portfolio and it does XYZ. I can take a risk here. I can go step outside a little bit of my comfort zone and buy this bigger business that might have a little bit more complex in terms of operational status, but it's fine because I already have this portfolio that runs very well, is growing or whatever it may be. And I can do this because if we hit on this, it'll take us to here.
Okay. This is my last question for you.
Sure.
And I think it's actually really interesting. Hopefully it doesn't bore you.
I'm sure it's not the last one, but
no, this is my last question. I'm getting hungry. No, I'm just kidding. You have all this data. You're watching all these brands. You're doing all this research. You're automating all the data aggregation and the data analysis. And you've got this killer M&A team. And you have 30 brands and you want to get to 60 brands. But now you have all this operating experience, brand experience, Amazon experience. Do you ever sit back and think, wait a second, we've raised all this money, and not just you, I think some of the other aggregators as well. Do you have this idea that maybe, like, wait a second, We know where the gaps are in our portfolio. And we've got a team filled with amazing aggregators and product people. If we see where the gaps are, would it be cheaper just to start that brand ourselves and add to our portfolio in a way that's cheaper as opposed to paying a 6 times revs multiple for something?
It's a question that sellers themselves ask us often. It's like, well, why don't you sell? Like, why don't you start from scratch? And we have, but the process and the time that it takes to get up to that $1 million with a good rank, with good keywords, with, solid number of reviews, with, that takes time no matter what. You can even, probably fastest do it in 6 to 9 months if you hit on everything.
Right.
And that's including the design, the production, the supply chain, getting it to the US, getting it to FBA, the listing, the translation, the sales, the keyword, the rank, right? It just takes time. And that's the real issue is the time, not necessarily the money or the expertise. So if we could take a business that already has inventory landed with rank, with, sales, with review, like a review mode, knows who their competition is, being able to be optimized rather than starting from scratch. That's kind of where the sweet spot is. Like we look at brands and look for opportunities to grow the brand, right? How do you double it? How do you 5X it? How do you 10X it?
Interesting. And I think I have one last question as well.
That's fine.
Which is like, we saw all of those aggregators. No, I have 2 more questions. The first one would be like, we saw all of those aggregators announcing how much they raise and can be like kind of proud of that. I'm wondering, like, isn't that dangerous? Like, first of all, like, when you see that there is so much money and you are on the seller side, like, at the end of the day, I'm like, okay, I know you have $400 million, guys. So you know what? Let's put a bit more number here. But also, like, from a seller point of view, I know that there is tons of competition that can just go on TechCrunch and just have the list of everybody who raised how much, like, the money they have, right? So why does everybody announce that they raise money into this context? I'm wondering.
2 things that I think. One, they're trying to show off. And it's a bit of a competition amongst aggregators to say, well, I raised 100 million, I raised 200 million, I raised 300 million, because then, if you know that I raised $1 billion, which a company just did, now if you are a business doing $50 million EBITDA, you know that they can easily give you 5X for what your business is doing, right? Or something like that. The other part of it, I think, is for the next round of funding, right? The next time they go to raise money, it's like, we raised $300 million, and guess what? We need more. We need to acquire more because we've spent this effectively and growing this business. We're spending responsibly and growing the businesses that we have bought, and we just want to continue to add to that. So when you go out to market, looking for a Series B or Series C, you can see the trends of your businesses and then also the competition and what those guys got at a Series B valuation or Series C valuation.
It's definitely okay. And so it leads me to my next question, which is, if we want to keep raising funds and if we want to keep working with investors, but as the market is not gonna grow that fast, I guess, I don't know, like I guess the market in terms of sellers, and as you say, like some aggregators start to go to kind of like other things than Amazon brands. So do you think that it's gonna grow, like this fact of going to acquire other brands, maybe DTC brand that sell, on their own website? Do you think this is going to grow, or this is going to stay mostly on the Amazon FBA side of it?
I think 2022 will be very telling. I think from our perspective, Elevate's perspective, we're open and we're playing ball with everyone. I think it'll be a bit of a divide in terms of the ones that only know Amazon and only spend on Amazon and only buy Amazon businesses. And then there's also ones that, maybe this space is no longer the Amazon aggregator space and more so the online business aggregator space, right? Whereas if the business is D2C, or if the business is majority on Shopee, or if the business is majority on, Price Minister or whomever it may be, it's still a solid business in a solid market, and perhaps they're the best seller of this category and doing significant business, right? It doesn't just have to be Amazon. I think in reality, the ones that will be here at the end are the ones that diversify, because from an Amazon perspective, there's no guarantees for how long they will be there. Yes, third-party sellers do make up a majority of Amazon's business revenue, but it's not easy to be a marketplace seller anymore. Right. Things change every single day. Rules change, terms of service change. And, that's honestly where we see a lot of the businesses that come to us and say, I'm tired of it. I don't want to do it anymore.
Yeah, manage this. Right? It's so hard, right? Yeah.
I'll take my money and I'll go reinvest in real estate or in crypto or whatever it is. Like, honestly, those are things we see all the time because they feel like they have more control over that than they do over maybe their Amazon business.
That's very interesting, and also something that I see from my point of view. Through Dr. Tate, we are working with companies who are doing DTC exclusively, and not a lot of those brands consider selling on Amazon. Right. Really, they really want to invest into SEO, for example, to get some organic traffic in some time. They want to invest into ads, and they want to build the brand and the Instagram account and the Pinterest account, right? But they don't really consider selling on Amazon, something very, very important for them. So maybe there's also an opportunity for you here, because if you know Amazon very well, then you can just put them on Amazon and almost get sales for them almost instantly. And it's something that they don't do at all. Zero. So
yeah, I have seen an emergent business that is out there to do the same thing for Shopify businesses, to acquire and operate Shopify businesses. Right. But again, they're a little bit behind the curve, I think, in terms of the aggregating of online businesses. If it all comes down to the internal operational structure and the capacity, if you have smart hires and you have capital, you can run those businesses, because in reality, the end consumer is the same. The way you reach them might be slightly different, but if people are going to buy those products off a marketplace or off a D2C site, you have the ability to sell to them, and then us, to make that money. So I think it's a little bit away, maybe 3 or 4 quarters away, maybe 2023 before it's much more prominent, but I have seen it already start.
Interesting.
Very interesting. Okay. TJ Hyland, the Director of Global Partnerships for Elevate Brands. That was brilliant. Really. Thank you so much for your time.
Thank you very much. Super interesting.
Thank you both.